Well, good morning, everyone. This is Gustavo Friedrichsen, CEO of the LA County Medical Association. And for those of you who are joining us today, thank you for joining us today, and thanks for taking the time out of your busy schedules to join us today. As most of you know, as LACMA members, we have strategic partnerships with many organizations, but none is more exciting to us right now than the partnership we have with ACap advisors and accountants. They are the best in breed, in our opinion, when it comes to advising and preparing and being subject matter experts to our members when it comes to a variety of issues, including taxation and wealth management. We're going to start the webinar, and I wanted to introduce the founder and president of ACap, Oghoorian, in a moment. But I also want to let folks know that this will be about a 45-minute webinar, and we'll take questions at the end, but you can submit your questions through the portal as we go through the webinar. So without further ado, I'd like to introduce Oghoorian, founder and president of ACap Advisors Accountants. It's all yours.
Great, thank you very much, Gustavo. Thank you for the very kind introduction. Hi, and welcome to the first of many webinar series that we're going to do with the LA County Medical Association, LACMA. I do want to point out before we begin that this is an educational series. Again, one of many. And what we mean by educational is we intend to inform you about different hot topics that are going on right now. And rental real estate, especially if you're in the LA area, is something that's on top of mind for many people. And so as a result, we want to provide some educational material for you as you go out there and start looking for rental properties. We're very, very excited about our new partnership with LACMA, and we're really looking forward to becoming a trusted resource for the LACMA members. A little bit about me, as Gustavo mentioned, my name is Oghoorian. I'm the founder and president of the ACap Advisors and Accountants. We are both a fee-only wealth management firm, and we're also a CPA firm. What really makes us unique is that nearly 100% of our clients are in healthcare. And what we mean by healthcare is that means physicians, nurses, medical groups, IPAs, all types of individuals and companies that are within the healthcare industry. On the wealth management side, we do fee-only wealth management. What that means is we don't sell any products, we don't work on a commission. On the tax side, we provide full service tax advice and support for clients. That means payroll, bookkeeping, taxes, business services, anything really under the umbrella of taxation. A few housekeeping items. This webinar is being recorded, and once we're done with the webinar, we're going to post it on our website, and it'll also be available, I'm assuming, on the LACMA website and other resources where you can look into and view it at your own leisure. If you do have a question, please go ahead and submit it on the bottom. You'll see there's a Q&A button somewhere on your screen where you're able to click a question, and then we'll get to all the questions towards the end of the webinar. Gustavo, were you about to say something? I cut you off, sorry.
Oh, not at all, not at all.
So without further ado, let's go ahead and get into the roadmap of what we're going to discuss today. But before I actually talk about the roadmap, I want to point out that the purpose of this presentation is geared towards people who are doing rental real estate, not residential real estate. So if you're looking to buy your first primary home that you're going to live in, or you have questions about your primary residence and taxation of it, this presentation is not for you. This presentation is 100% geared towards someone who wants to buy rental properties or owns rental properties and is interested to know the taxation or the tax implications of owning rental property, especially with the new tax laws that went into effect this year. First, a couple of key definitions. When we do the roadmap, we're going to talk about some characteristics of real estate and what makes real estate unique, not only as an asset class, but as an investment, long-term and short-term. I'm going to talk about the differences between residential and commercial real estate, because this tends to confuse a lot of people, and I want to clearly delineate what is residential and how that is defined among lenders and also investors, and what is commercial real estate. Then we're going to jump into the meat of the presentation, which is how the Tax Cuts and Job Act, which is the new law that went into effect January 2018, and how it affects rental real estate. Because up until very, very recently, there was a lot of confusion on how the new tax law changes would affect people who do own rental real estate. We're going to talk about the new real estate safe harbor rules, which came as a result of a confusion among many real estate owners and whether or not real estate did qualify. And then I'm going to talk about depreciation, because depreciation is something, as we see here, it says it helps now, but it hurts later. And I'm going to explain what I mean by that, because depreciation is a key factor of owning rental real estate, but it's important to understand how depreciation helps and how it can potentially hurt you later on. So I'm going to do a deep dive into depreciation. Next, we're going to cover passive activity loss rules. And that's also important to know, because there's a misconception among real estate owners on the deductibility of certain expenses and losses when it comes to owning rental real estate. Then we will also talk about direct real estate versus owning REITs. REITs are also known as real estate investment trust securities. And then lastly, we're going to close out with introduction to opportunity zones. And we're just going to really touch on opportunity zones, because there's going to be a whole separate webinar there. We're going to do a really deep dive into opportunity zones, because this is a result of the new Tax Cuts and Jobs Act that went into effect, and it has a tremendous impact on taxation and investing in what these are known as opportunity zones. It not only touches on real estate, but also other types of investments as well within these opportunity zones. And then we're going to close out with how ACap advisors and accountants can help you with this entire process and be a trusted resource for you. Here are some of the key characteristics of real estate. So real estate is a separate asset class. And what we mean by asset class is that an asset class is a segment of the overall universe of different types of investments. So a lot of people have heard of the S&P 500 or the Russell 2000 or emerging markets. All those are slivers or different parts of the overall investment universe. And real estate is just one part of it. There are many other asset classes, such as US large companies, US small companies, international, emerging markets, bonds, corporate bonds, and again, real estate is just one sliver of that. Another attribute of real estate is that it's very illiquid. If you own a $10 million apartment complex and you need $100,000 or $50,000, you can't sell a few doors and windows to raise that money. Basically, what you have to do is, short of selling it, you have to do a cash out refi, or you have to get a line of credit, and that ends up being costly. So it's a very illiquid type of investment. And we'll also circle back to its illiquidity later when we're talking about depreciation and how depreciation essentially captures a person in real estate and really prevents them from kind of diversifying out into anything else. Real estate, another characteristic is the leverage factor. So the leverage factor basically means with a small amount of money, a down payment of 20% or 10%, you can essentially control a very large asset. And that helps when that asset grows in value, because that leverage amplifies the return, but it also cuts both ways. Meaning, if that asset declines in value, that leverage that you're employing now is going to amplify your losses. So be careful how you look at leverage, because it'll cut both ways, especially when the asset value goes down in value. Next characteristic of real estate, it's got a high barrier to entry. And what we mean by that is the down payment and the closing cost. So for you to be able to get into a rental property, especially in an area like LA, when it's, trying to find something under $1 million is very, very difficult, you're going to need to come up with at least $200,000 just for the down payment of that. And that's not even factoring in closing costs. That's not factoring in having excess liquidity after the fact, because most lenders are going to want to see some sort of cash reserves after the transaction is closed. Another reminder, if you have questions, please go ahead and tap the Q&A and we'll get to all the questions at the end. Okay? Another characteristic of real estate is that it's very interest rate sensitive. It's actually inversely related to interest rates. What that means is if interest rates decline, real estate prices go up. If interest rates go up, real estate prices go down. And right now, we're in a very, very low interest rate environment. The likelihood of interest rates going further down is less than the likelihood of interest rates going up. So as you can already imagine what the result would be if interest rates start to rise. Last two components of characteristics of rental real estate is that you have annual maintenance costs and annual expenses. Annual maintenance would be, potentially a new roof if there's been any deferred maintenance on the property, changing your AC, your air conditioning units, or putting in a new water heater. All those things are expenses that need to be taken into consideration when you're managing property. And then lastly, but definitely not least, is dealing with tenants. Once you have tenants in there, then it's a matter of servicing those tenants, making sure that they're getting the things that they need, and finding good quality tenants as well. So let's go into some of the other characteristics of real estate, differentiating between residential and commercial. Residential real estate is a very commoditized product, or a very commoditized lending function. That includes basically anything that is a 1 to 4 units. So it would be a single family home, a condo, a duplex, triplex, quadplex. When you're buying residential real estate, the underlying criteria is all based on the borrower's income and their credit worthiness. So if you imagine when you're buying your primary residence, they're going to look at your tax returns. They're going to see how much money you make, what your debt to service income is. They're going to see what your credit score is. And all those factors determine whether or not you qualify to buy that home. On the commercial side, it's a totally different animal. It's a very, very different type of loan. Commercial is 5 units or more, and it would include an apartment building, 5 units or more. It would be an office building, a warehouse, a strip mall, anything that does not neatly fit into that 1 to 4 unit I mentioned above. On commercial side, the lender looks at it as if you're running a business, because in a sense, that's what you're doing. You're running a business. And the lending function is solely based on the income of the property. If the income of the property does not support the loan, then that means you have to put a bigger down payment down to get to the point where the cash flow of the property has to be able to service that loan. If it's not, then the owner's personal financials are of secondary concern, and not so much concern, but of secondary value. The lender goes to the owner's financials only as a secondary source of repayment. The primary source of repayment is the property in question. So it's very, very important to take into consideration, because as you're going out there and looking for different rental properties, you want to know what type of property you're buying, residential or commercial, and how you have to structure and prepare your finances to be ready to get that loan and to qualify for a loan that you need for that type of property. Okay. All right, so let's talk about some of the changes that went into effect as a result of the new Tax Cuts and Jobs Act and how it relates to rental real estate. Again, the focus of this is only going to be about rental real estate. There's been a lot of changes that occurred with the new Tax Cuts and Jobs Act that relate to primary residence, but we're not going to talk about that at all. We're only going to talk about the rental real estate aspect of it. One of the biggest differences, or one of the biggest changes that went into effect, is what's called the Section 129 deduction that was increased. And essentially, this is like a bonus depreciation. So if you put an asset in place in a given year, before 2018, you were able to take a bonus depreciation of up to $500,000. That got doubled to $1 million. So if you put in a new huge AC unit, or if you put in a leasehold improvement or something large, where it was over $500,000, before you were limited to how much you can take that as a deduction that given year, now that's doubled to $1 million. So it's a really huge deduction, especially for companies or real estate that's very, very capital intensive. The other big change is the 1031. So the 1031 is essentially when you take an asset, real estate asset that's appreciated in value, and you instead of selling it and paying tax on it, you can exchange it and defer the tax and exchange it into another property. And when you do that, you don't pay capital gains tax on it, and because you basically exchange it for a new investment property. So prior to 2018, the rule was that you can take any type of property and you can exchange it for rental property. So if you had personal property, or if you had equipment, or if you had a large commercial warehouse, you could exchange that into real property, an apartment building or a multifamily or a duplex. You can no longer do that. The new law says it has to be like-kind exchange. So real property has to get exchanged for real property. So that's a really, really big change that went into effect as of the new Tax Cuts and Jobs Act. Another really big one that was a clarification, and because when the Job Act first passed, there was a tremendous amount of confusion among the public, especially business owners, on what really qualified for that QBI deduction, that Qualified Business Income Deduction. That's a huge 20% deduction on qualified business income. And there was confusion as to whether real estate qualified or was eligible for that deduction. And until very recently, there was some clarification from the IRS that says, yes, real estate does qualify, and there's a safe harbor rule that would allow you to qualify if you meet certain conditions. So this was a big boon to the real estate industry that allows real estate to be qualified as a trade or business. Whereas many physicians are S corporations and they operate in their medical practices, if their income is above a certain amount, they're deemed to be a specified trade or business. And if they are one of those specified trade or business, service trade or business, then they're disallowed from the QBI deduction. But real estate has this new definition where they're not allowed, where they are qualified trade or business and they are eligible for that QBI deduction. We have a completely separate webinar that does a really deep dive into the QBI and the 199A deduction and how it affects businesses, both specified service businesses and non-specified trade service businesses. I also want to point out that I really gave you a really broad overview of these changes that went into effect related to rental real estate, but there's a lot of fine print related to all of these different changes. And it's really, really important to talk to a professional before you make any of these changes. Otherwise, you're going to get caught in a situation where you're going to owe taxes where you didn't really anticipate owing those taxes for those. So let's talk about what are the safe harbor rules for the real estate. To be able to qualify as a trade or business related to real estate, you have to meet certain criteria. You have to spend 250 hours per year on that business. And what that means is there has to be 250 hours a year collecting rent, hiring contractors, doing repairs, visiting the property, any type of management-related work for that business. Now, the really cool part about that is that it doesn't all have to be you that spends the 250 hours a year. You can outsource that to a property manager, and that would still qualify for the safe harbor rules, which is a great, I don't want to say loophole, but a great exception to the rule for the safe harbor. The other is you have to maintain separate books and records. It cannot be commingled with your personal records. So you have to open up a separate bank account, maintain maybe a QuickBooks file. I would highly recommend doing some sort of QuickBooks record-keeping file for that, but keep it separate. That's how you're going to justify that it is indeed a separate business entity. And keep in mind, when you have rental real estate, you are running a business. You have to look at it from a profit and loss perspective. You have to know your numbers. And the only way you can do that is to keep meticulous records of your income and expenses. You have to maintain contemporaneous records. And it doesn't have to be retroactive. It could be going forward from 2019 and forward. So that's also very important. And what I mean by that is keeping records of invoices that were paid, or rent checks that were received, vendors that were paid. All those things need to be meticulously kept, and you can also do that within a QuickBooks file as well. Right? Another thing that you can do is you can group like-kind properties. And what I mean by like-kind is, let's say you have 5 or 6 different apartment buildings. You can group them together, and then when you group them together, just to point out, they have to be like-kind. So you can't take multifamily and group them in together with warehouses, or you can't take warehouses and group them together with residential. It has to be similar types of properties. And when you group them together, you can take advantage of that 250 hours per year, or maintain separate books for that group versus having to do it individually. So that's a big benefit of doing the grouping. Also, I want to point out is once you group them together, you cannot ungroup them. So be very careful when you decide to group several types of properties together, because once you've done that, you cannot undo it. The last one that's really, really important is triple net leases do not qualify for the safe harbor rule, nor do they qualify for the test of a trade or business for the new Tax Cuts and Jobs Act QBI deduction. And triple net business or triple net lease is essentially, let's assume that you're the landlord and you leased out your property to a tenant under a triple net lease. In that situation, the tenant is responsible for everything. They're responsible for property taxes. They're responsible for insurance. They're responsible for any payments, lease payments. All you're responsible for as the owner is just to collect the check. If that is the case, then you're not eligible for the safe harbor rule. A typical lease is when, as the owner of the property, you're the one that's paying the property taxes. You're the one that's paying the insurance. You're the one that's paying the maintenance. And the leasee, the person who's leasing the property from you, is just writing you a check. And if they've got any problems with the property, they contact you and you're the one that fixes it. So there's a clear difference of different types of leases involved here. And it's important to know. Next, let's talk about depreciation. And you'll see I have a little side note. It helps now. And in the next slide, it hurts later. And I'll tell you why it hurts later, because this is one factor that most people do not take into consideration. You have to take depreciation and all its benefits and drawbacks into consideration. So first, let's define what depreciation is. It's the annual reduction in the value of an asset due to wear and tear. And let's peel back the onion a little bit more. Let's assume that you bought a air conditioning unit, and the air conditioning unit has a useful life of, for example, 10 years. That means after 10 years, you're going to have to replace that air conditioning unit. And if you paid $10,000 for that air conditioning unit now, you have to allocate that expense over a 10-year period, because that expense, that air conditioning unit, is used over a 10-year period. And as a result, you have to amortize it or depreciate over that 10-year period. Now, depreciation is a non-cash expense. What that means is, even though you take it in the year that you incur, after the year you incur the cost, it's not cash that you outlay. So continuing with the same example of the air conditioning unit, if you bought it for $10,000 this year, the following year you take a depreciation against it, but it's not as if you're paying cash out again. Hopefully that made sense. If it doesn't, please pose a question. I'll be happy to answer that. So let's continue in the example. Let's assume you have a property that generates $80,000 of rental income. You have $20,000 of expenses in a year, and you have $10,000 of depreciation for whatever reason for that property. The net paper profit is $50,000 a year, but your cash profit, net profit, is $60,000, because that $10,000 is a non-cash expense. Make sense? Let's continue with another example. Let's assume that an investor buys a triplex and they bought it for $1 million. And the value of the land is $400,000. So what that means is you can only depreciate $600,000 of that purchase. And the reason is because land is not depreciable. Land is held for an indefinite period of time, and there's no wear and tear associated with land. Now, if you had land that was depletable, meaning you had oil reserves in there or timber on there that were cutting down, that's a whole different situation. But if we're just talking about a triplex or rental real estate, the land portion has to get separated out because it's not depreciable. So in this case, you have $600,000 that's allocable towards the building, the structure, and you would depreciate it over 27 and a half years. And there's a reason why there's 27 and a half years. 27 and a half is for residential. Keep in mind, this is a triplex, so it's deemed residential. If it was commercial, you would depreciate it over 39 years. I don't know why the IRS has these two different differences, but that's the case if it's residential or if it's commercial. So in this same example, that $21,818 every year, the owner of the property, the investor, would take that as a deduction against their rental income. So it's a non-cash expense that they're taking every year, but it's reducing their taxes because they're not paying tax in that portion. Right? Again, if you have a question about how depreciation works, let me know and I'll explain it later on during the Q&A process. So now let's talk about how depreciation hurts later, because many people buy real estate with the expectation of taking that depreciation deduction, which is definitely the right thing to do. You want to take depreciation because it's a way of reducing your taxable income. But when you sell the property, there's this thing called the depreciation recapture. And essentially, all the depreciation you've taken over the years will come back as ordinary income, and you have to pay tax on it. So I'm going to repeat that because it's very important. Any depreciation you've taken over the years, or even if you have not taken it, will come back to you when you sell the property, and you will owe ordinary income tax on it. So you'll see I have it underlined, even if no depreciation was taken. I'll give you an example of a situation we've had recently where a client sold the building that they'd owned for several years. They'd never taken depreciation on it, and they sold it, and then they came to us afterwards. They sold it and said, okay, what can we do to reduce our taxes? Well, the bad news is that not only can they not do a 1031 exchange and defer that income on there, but they never depreciated the property and took advantage of that deduction, but now they have to pay tax on that recapture of the depreciation they never took. So it's kind of like a double whammy they got on taxation. Let's continue with the same example of that investor that bought that triplex for $1 million. So now they're going to sell it for $2 million. And they had fully depreciated. Let's say they took the entire $600,000 of depreciation during that time period. So there's two components of the taxation here. One is the capital gains tax on $1 million. They bought it for $1 million. They sold it for $2 million. They have to pay capital gains tax on that $1 million part. That's capped at a maximum of 20% federal, right? Capital gains. But the depreciation, that $600,000 they took over the years, that's taxed at ordinary income, which is a maximum rate of 37%. So unless you take that into consideration, which most people don't, that is really, really important because it'll come back to bite you and it will be a huge tax hit. I mentioned earlier 1031 exchange. You can avoid the depreciation recapture or the capital gains tax by doing a 1031 exchange. But then what happens is you're locked into that real estate. So hence the illiquidity of real estate and why when you buy real estate, you're essentially locked in, and it's very difficult to get the money out short of doing a cash out refi, which is costly, or doing some sort of a equity line on it. The next thing is we hear a lot of clients come to us and say, well, I want to buy real estate because I want to get the tax deduction and because my income is too high. And that may very well be the case. However, there's more to that than just getting the tax deduction, because real estate is deemed what is known as a passive activity. And passive activity, if you have losses, can only be offset against passive income. So if you've got W-2 income from an employment job and now you buy real estate and you're recognizing losses on there, you cannot take those losses. those losses are going to be suspended and only be unsuspended once you sell that property. So it's really important to recognize that if you have passive losses, you can only offset passive losses against passive income. Keep that in mind. Plus, there's a thing that's called active participation and material participation. For you to be able to take any losses, you have to have material participation in that activity. And to be a material participant, you essentially have to be a real estate professional. And it's very difficult to qualify as a real estate professional if you have any kind of full-time job. So if you are a W-2 employee anywhere, it is nearly impossible to qualify as a material participant in the eyes of the IRS because you have to spend an inordinate amount of time managing that property and doing a lot of different tasks for that property and treating it as a business. And it's difficult to qualify for that if you have a regular job. There is a special $25,000 loss allowance allowed for active participation. Remember, not material participation, but active participation. And what that means is just basically if you're an active participant, you can still have a full-time job, but you're collecting rent, you're finding tenants, that type of work. But to qualify for that 25%, that $25,000 loss a year, your modified adjusted gross income a year cannot be more than $150,000 if you're married filing jointly. If it is, you don't get that deduction. If it's below that, then you're eligible for that deduction on the rental property. Right? So let's compare direct real estate with REITs, real estate investment trusts. And we're not arguing one is better than the other. We fully believe that it's important to have all types of assets in all different types of asset classes. And as I mentioned, real estate is an asset class, and REITs are a different asset class. So is large cap companies, small cap companies. So it's important to be well diversified into all those categories. But it's also important to understand the differences between the two types of investments. So let's see how they compare with one another. So a direct real estate is what we've been talking about just now, owning an office building or owning a rental property. Direct real estate is very illiquid for all the reasons I just mentioned before. A REIT, a publicly traded REIT, something that you can buy and sell on the New York Stock Exchange, is very, very liquid. So if you have $1 million in real estate, direct real estate, it's very hard to carve out $50,000 or $25,000 from that. But with a REIT, you can easily do that. You just sell off $25,000, no problem. The barrier to entry on direct real estate is very high because you have that down payment requirement, which for many people is very difficult to do. On a REIT, it's very low, the barrier to entry. You can buy a REIT for $50 or $100. So very, very low barrier to entry. The costs associated with direct real estate are very high because you have annual maintenance, you have closing costs, you have insurance. All those things come into play when you're managing that rental property. But with a REIT, the annual costs are very, very low. You can get into a REIT for maybe 20 basis points, probably even lower than that, which is $20 for every $10,000 you have invested. And that is a very, very low cost to get exposure to real estate. The other are tax benefits. As I mentioned, with direct real estate, you have that depreciation tax benefit that benefits you now, but may come back and bite you later. But you're also eligible for that qualified business income deduction with direct real estate. On the REIT, you also get that qualified business income deduction with the REIT, which is a big positive as well. Excuse me. The other factor of direct real estate is the leverage factor. I mentioned earlier that with a small amount of money, you can control a large asset, but that leverage factor cuts both ways. So it amplifies your returns, but if you have losses, it amplifies your losses in a symmetrical manner. So you have to keep that in mind when you're considering leverage for direct real estate. With a REIT, you can also leverage, although it's not advised, but you can do a leverage factor. It's a smaller amount, but Typically, people who buy publicly traded REITs, they don't leverage it. They just buy it outright, and it provides a good income stream with dividends and interest. And as of this year, you get that qualified business income deduction related to the REITs. The last difference between direct real estate and publicly traded REIT is the diversification factor. If you've only got $1 million to diversify, trying to buy direct real estate, even if you do a very small down payment, you're only going to buy 1, potentially 2, possibly 3 properties. That, in a sense, is really not a good diversification. With a REIT, with $1 million, you can really, really slice and dice that portfolio in many, many different types of REITs or many different asset classes. So it's very easy to get quick diversification with REIT, with just one single share of REIT that you can't necessarily do with direct real estate. But I want to underscore again, I'm not advocating that a REIT is better than direct real estate or otherwise. It's important to have exposure to both of them, but a measured amount. You never want to be over allocated to any one particular asset class or any one particular type of asset. It's very, very important to be diversified, not only asset-wise, but tax-wise as well. You want to have some money that is in a tax-deferred account, in a tax-free account, and in a taxable account. So very important to diversify in many different cross-sections as well. Okay, last part of it is the opportunity zones. So the opportunity zones were also created under the Tax Cuts and Jobs Act. And I'm going to really briefly talk about this because, as I mentioned earlier, we're going to have a much more detailed webinar that we're going to take a deep dive into the opportunity zones, but I want to quickly talk about this. So the opportunity zones are zones within every state that were identified by the governors. And there are a lot of areas, even within LA County, that are deemed opportunity zones. And these are zones that are low-income areas for a variety of factors. And the idea behind that is, as an investor, you can invest in these opportunity zones. And if you hold a property for 5 years, you get a step up in basis of 10%. If you hold a property for 7 years, you get a step up basis of 15%. But the real benefit comes if you hold a property for 10 years. If you hold it for 10 years or more, you get a 100% step up in basis, which means you pay no capital gains tax, which is enormous. It's a huge opportunity. The other real benefit of the opportunity zone is that it's very flexible. It's much more flexible than a 1031 exchange. So if you recall, I mentioned earlier that with a 1031, it has to be a like-kind property. You cannot take a sale of appreciated equipment and convert that or transfer that into a multifamily home. But with the opportunity zone, you can take appreciated Amazon stock or appreciated Apple stock or any S&P 500 index fund that you might have, and you can take that capital appreciation and you can exchange it into and invest it into an opportunity zone. Not only that, you have it 180 days after you've sold a property to make that decision, which you don't have with the 1031 exchange. So as you can see, it's a really flexible feature of this new tax law that allows you to deploy your assets in a very tax efficient manner. And as I said, a capital gain from any asset qualifies, even if you bought Bitcoin. Hopefully you didn't, but if you did and you were one of the very, very few that made money off it, you can take that capital gain and deploy it into an opportunity zone. A webinar, we're actually going to do a panel discussion webinar on this, and it's going to be very, very in-depth, and we're going to do a deep dive into all the nuances with it because I just really scratched the surface on it. But as with anything that comes out with the IRS, there are so many nuances to it that you don't want to get entangled with an exception that you did not anticipate beforehand. Which brings us to our closing slide on how a trusted advisor such as ACap can help. We do this on a day-to-day basis, working with a trusted advisor and a financial, both a trusted tax and a financial advisor could really help clients walk through the most important aspects of this before the client actually make that decision. The last thing you want to do is come to your tax advisor or your financial advisor and say, I just sold this property. How can I avoid taxes? That's the worst time to do it. You want to be proactive and say, I'm thinking about selling this property, or I'm thinking about selling this investment. What can I do now to minimize my taxes and to be well prepared so that I can redeploy those assets in a tax efficient manner? That's really important. Another thing is a trusted advisor can help you prepare accurate financial statements and tax returns, because when you're going to a bank to get financing, they're going to look at these tax returns. They're going to look at these financials really, really closely to make sure that, are you indeed qualified to buy this property? Do you have any experience with buying properties like this? So it's important to have accurate financial statements, and having a CPA prepare those adds a tremendous amount of credibility to the bank versus just having the client themselves prepare it, because the bank is going to discount those statements. Obviously, working with an advisor, make sure that there's no deduction that's left untaken. We're going to thoroughly review all types of deductions that are applicable to our clients and make sure they're taking advantage of those. And of course, making sure that we're staying current on all tax laws and financial opportunities, because as we've seen, these things change all the time, and we want to be up to date on what's going on with the tax laws and financial opportunities that are out there and take full advantage of them. I know that was a lot of information, but hopefully this opens the opportunity for you guys to ask questions. Okay, give me one moment. I'm going to take a drink of water because I've been talking for a good 40 minutes or so, and I want to be able to just give me 1 second. Okay, so we have one question that says, so on the depreciation recapture, you pay capital gains on the full gain plus ordinary income on the depreciation. Yeah, so if I understand the question correctly, that is true. You not only pay capital gains on the difference between what you sold it for and what you bought it for, but you pay ordinary income tax on the amount of depreciation you either took or that you should have taken. Remember, it's both. If you did not take the depreciation you're entitled to, you still have to pay tax on that. So effectively, you're paying tax on 1.6 million instead of 1 million. I guess it's referring to, the question is, so effectively you're paying tax on 1.6 million versus 1 million. In a sense, yes, the 1 million you're paying tax on capital gains, the 600,000 you're paying tax on the depreciation recapture. Because think about what happened during the years when you're taking that depreciation, you're lowering your ordinary income tax. So in the eyes of the IRS, you now have to pay back that money that you got a benefit from reducing your ordinary income tax. I don't know if this is a good analogy, but think of it as like a 401k or an IRA. When you put money into a 401k or an IRA, you get a tax deduction in the year you put the money in, but then later on, when you're taking the money out, you have to pay tax on it. So it's the same concept with the depreciation recapture. You're getting the deduction the year that you put the money in, but then when you take the money out, you have to pay the tax on it. Next question is, I have a rental property, but I have not been depreciating it. Do I still owe depreciation recapture when I sell it, or can I just not pay since I didn't get the tax benefit depreciation anyway? As I said earlier, even if you don't take the depreciation you still have to pay the tax on that amount at the end. So unfortunately, you still have to pay it. And we did see this with a client that sold a property before consulting us, and it was after the fact. There's really nothing we can do at that point. Can I qualify? Next question is, can I qualify as a real estate professional under the safe harbor rules if I'm a full-time employee of another company? No, you cannot. So it is very, very difficult, if not impossible, to qualify as a real estate professional if you've got a W-2 job and you're working someplace else, or if you're doing anything outside of your normal day-to-day job, then it'd be very difficult to qualify. Because essentially, you have to spend, I believe it's over 500 hours a year, and you have to spend a substantial amount of your time working on that business. And keep in mind, it is a business indeed that you're running. Let's see. What activities qualify for working in the real estate profession? Do I have to be a realtor or a house flipper, or do other jobs qualify as well? So that's a good question. And now if you're a house flipper, that's a whole different scenario, because when you're flipping houses, now the house is not so much an investment, although it is in a way an investment. It's inventory, because if you're flipping several houses in a year, now it's considered, in a sense, inventory, and it's really taxed in a whole different way, and it's beyond the scope of what we're discussing. So if you are a house flipper, there's a whole other set of rules that need to be taken into consideration. Let's see. If I do not have profits from my real estate rental, do I still get the $199A deduction to offset my other income? No, you do not. So if you have no profits, then there's really no deduction, because remember, QBI stands for Qualified Business Income. So if there's no income there to be able to take 20% deduction off of, then you don't get that 20% deduction. Last question we have is, what happens to my losses on rental real estate if my income is too high to take the losses for the year? That's a really good question. What happens is they become suspended losses, and they're not all lost. What happens is when you actually ultimately sell the property, then those suspended losses become unsuspended, and you're now able to take them again once you sell the property. So you don't lose them outright, but they just get deferred into a future year. I think that's all the questions that we have. Also, we're 46 minutes into it, so hopefully this is informative. Gustavo, any questions or closing comments you might have?
Well, thank you so much, Ara, for doing this, and thank you for the ACap advisor and accountants family. Those of you who participated, thank you again for joining us. I know your time is precious. If you have any questions of us at LACMA, you can always email me at gustavo@lacmanet.org, or you can email Eve at eve@lacmanet.org, or you can contact Ara and his team directly. Thank you again, everyone, for joining us today.
Thank you, Gustavo. Thanks, everyone.